This is Alan Bush with the Daily Financial Forecast for Thursday, September 29th. Starting out with the stock index futures, we are seeing prices just a little bit lower this morning, although I'd have to say holding up relatively well, even though we did have the pending home sales report for August coming in weaker than expected. In fact, it was supposed to be unchanged. It did come in at down 2.4%. So I'd have to say that we're holding up rather well in spite of some bearish news. Also, we did have the second quarter GDP coming in up 1.4%, a little better than the estimate, but consumption spending actually showed a little bit of a smaller than expected increase, so those appeared to be offsetting numbers. Overall, we do feel that stock index futures are still in a bull market. I would look for higher prices for the balance of this year and probably well into next year also. Now, moving over to the currencies, the dollar index still a little bit higher, holding up, I'd have to say, very well in spite of the mixed GDP data. Also holding up well, even though we did have the pending home sales report, a little bit disappointing, as we mentioned earlier, coming in with a decline. But keep in mind that the Fed is still the only major central bank that is on track to raise interest rates either later this year, possibly at the December meeting, or maybe early next year. So interest rate differentials continue to be supportive to the dollar index. So I would look for a sideways to higher trade for the greenback for the rest of this year. Also, we are seeing the yen coming under some pressure. This after the OPEC deal caused some flight to quality longs to be liquidated in the Japanese yen. Also, what appears to be a better situation in the banking industry in Europe, also a reason for flight to quality longs to be liquidated in the Japanese yen. And the pound a little bit lower with UK mortgage approvals coming in on the weak side. Longer term, we do feel that the Australian dollar will gain on the Canadian dollar, although that is not the case today. But in the last few months, there have been strong gains in the Aussie dollar over the Canadian. This is a trend that is likely to be a long-term situation, especially with China's economy, we feel, in recovery, and Australia tends to benefit very much by any type of improved economic condition in China. Also now moving over to the interest rate futures markets. As you know, the long end is very susceptible to inflation news, and we did have inflation in the Eurozone coming in stronger than expected. Also, the OPEC deal, which is the first agreement to cut production since 2008, should be viewed as a bit on the inflationary side. So as you would expect, or might expect, the long end of the curve coming under some pressure, namely the 30-year Treasury bond futures. And we feel that this is a trend that will probably persist. So I think we are in the early stages of what could be a bear market for the 30-year Treasury bonds, especially if we are correct in our thinking that inflation is coming back, although very slowly. We do feel that inflation levels globally will tend to accelerate. So continue to trade the bonds from the short side. So good trading, everyone. And once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.